Imagine Rahul wants to earn money from a corporate bond, but he does not have 20 million rupees to buy it. A bank already owns the bond. Rahul and the bank enter into a total return swap, or TRS. In this arrangement, the bank keeps legal ownership of the bond, but Rahul receives all the economic benefits and losses from that bond. Every year, Rahul pays the bank a market interest rate plus a small extra fee called a spread. In return, the bank passes on the total return of the bond to Rahul. Total return means both the coupon interest received from the bond and any increase in the bond's price. Suppose the bond pays a coupon of 5 rupees and its price rises by 3 rupees during the year. The total return is 8 rupees. The bank pays this 8 rupees to Rahul. If Rahul pays 4 rupees as the agreed interest payment, his net gain becomes 4 rupees. However, if the bond price falls instead of rising, Rahul must compensate the bank for that loss. Therefore, Rahul enjoys the gains and bears the losses of the bond without actually purchasing it. This is why a total return swap is often described as renting the returns of an asset instead of owning the asset itself. Now let's move to collateralized debt obligations, or CDOs. Imagine a bank has hundreds of loans, such as home loans, car loans, and corporate loans. Instead of keeping all these loans separately, the bank puts them into one large basket. This basket is transferred to a special company known as an SPV, or Special Purpose Vehicle. The borrowers continue making their loan payments, and all this cash flows into the SPV. The SPV then creates different categories of investors known as tranches. Think of these tranches as seats in a waterfall arrangement where money is distributed from top to bottom. The first group is the senior tranche. These investors are paid first and therefore face the lowest risk. Because they are taking less risk, they also receive the lowest return. Next comes the mezzanine tranche. These investors are paid only after the senior tranche has been fully paid. They take a moderate level of risk and therefore expect a moderate return. Finally, there is the equity tranche. These investors are paid last and receive whatever money remains after everyone else has been paid. Since they absorb losses first, they face the highest risk but also have the potential for the highest return. For example, suppose the underlying loans generate 100 rupees. The waterfall might distribute 60 rupees to the senior tranche first, then 25 rupees to the mezzanine tranche, leaving 15 rupees for the equity tranche. However, if some borrowers default and only 70 rupees is collected, the senior tranche may still receive most or all of its payment, the mezzanine tranche may receive less than expected, and the equity tranche may receive nothing at all. This structure allows investors with different risk appetites to invest in the same pool of loans. In summary, a total return swap allows someone to gain exposure to a bond without buying it, while a CDO bundles many loans together and distributes the resulting cash flows among senior, mezzanine, and equity investors according to a waterfall payment structure.